In addition to that, this is the fun part now. This is a visual representation of where you can place assets according to risk. So this is, okay, so you have aggressive, moderate, and safe. These are the three areas that you can place your assets according to risk and return, hence the chart. There is a line of risk, okay? Everything above that line carries some sort of risk. Everything below that line is, for the most part, safe and conservative. It holds its value, like real estate. Real estate, for the most part, is on this side of the equation. It's right here, real estate. So real estate is considered a moderate conservative asset that builds equity over time, but it doesn't, it holds its value. It doesn't fluctuate, not necessarily. This right here, this is your line of taxation. So everything on this side of the line is 100% taxable in some way. Everything on this side of the line is zero tax. You either already paid the taxes after tax, or you don't owe any taxes on those assets. Following so far? Okay, so when you're trying to figure out as an individual, what percentage of my assets should be where in this quadrant, right? So at the top of your paper, there's a blank line with a dollar symbol. I want you to put in your current annual income. This is for you guys to keep. This isn't going to me. So put in your current annual income, okay? So if I make $60,000, well then on that top line, I'm gonna put $600,000 because this is over a 10-year time horizon. Do you need a pen? Oh yeah, you guys got one?
No, sorry.
There's.
Oh, thank you.
Who you got? You got one? Good. Steve's on it. All right, so over a 10-year time horizon, right? So if I make 60 grand a year, granted this is gross, not net, you plan on gross, okay? Then over a 10-year time horizon, that's $600,000. So I'm gonna put $600,000 on the top. Got it? Then, underneath that line, there's two percentages. That is for you to determine how much, what percentage of my assets do I want to put away for the future? Do you not have one?
Oh, there it is.
Oh, there it is. I'm sorry, Steve.
It works.
Got the one folder that didn't have it.
Right?
Okay, so I'll give you an example, right? So if this 600,000 was at the top of the page, bear with me, it'll make sense, I promise. Okay, so if I want to save 20% of my income over the next 10 years, you following, Jeremy? Okay, so if I want to save 20% of my income over the next 20 years, right? 20% of 600,000 is $120,000 over 10 years. 20% of 600. So if I look at that number, that's pretty scary. $120,000. Dang, that's a lot. However, that's over 10 years. So if I look at that number over a year, that's only $12,000 a year. Okay? That's $1,000 a month. So 1,000 a month or 500 a paycheck gets me 120,000 over the course of 10 years. That's the math right here. Then it's like, okay, well now that I have what I want to save, which is $1,000 a month, where do I put it? Do I put it in aggressive? Do I put it in single stocks? Do I put it in my 401k? Do I put it in my Roth IRA, which is tax-free? Do I put it in my savings account? Do I put it in my tax-free municipal bonds? Do I buy a house? Do I buy an investment property? What is most beneficial for me? Okay? In addition to the savings account, you have money market account, you have CDs, you have fixed annuities, and you have bonds. So I've listed 5, you can't really see the 5, but there's 5 numbers on the side. Those are the 5 safe, secure assets where if you don't want to lose any portion of your money, you're going to put it right there. Those will not lose. They're not tied to market performance necessarily. They're tied to interest rates. So you won't lose, but you won't really gain anything either. So you don't want a large portion sitting here because you're not hedging against inflation and earning for the future. So we come across a lot of individuals that have a lot of money sitting in savings accounts. Couple reasons why you don't want it there, because it doesn't appreciate, it doesn't go anywhere. But number 2, banks can take that. And if the bank gets in trouble, do you know how much they would insure that account for?
$250,000 per depositor.
$250,000 per depositor, not account. Per institution. So spread your money around, right? Okay. So $1,000. Here's my chart. What do? Line of safety, the rule of thumb, take whatever your age. So I'm 42, so I'm gonna round up. Oh, I'm sorry, round down. 40% of my assets, 60% of my assets. 60% of my assets should be above that line in risk. And 40% of my assets should be below the line, safe and secure, hedging for the future. That's just a rule of thumb. I'm very comfortable with risk. So my current portfolio is 80-20. I want 80% of my assets aggressively invested for the future, 20% set aside for a rainy day. Any questions on that? I know I took you through that really quick. It's a lot of math. I love numbers. That's what I do. Did you have a question?
Oh no, it's really good.
Really good?
Yeah.
So 60%, 40%, so $400 down here. And $600 up here. $600 going into my 401k, or my Roth IRA, or my Roth 401k. So those don't have the income limitations that the IRAs have. And then $400 into any one of these accounts until you have 3 to 6 months. So I wouldn't recommend anything more than 3 to 6 months, depending on the nature of your work, of course. So I like to say, yes, sir.
Roth IRA don't have any limits?
So the Roth 401k doesn't have the income limitation that a Roth IRA has.
Oh, okay, but the contributions, you can only contribute.
20. So this year it went up.
Okay.
So the 401k contribution limits is $22,500 for 2023, which is pretty cool. It went up $2,000. And if you're over the age of 50, then you can contribute an additional 65.
Yeah.
So your total contribution into a retirement account is $30,000 if you're over the age of 50. And remember, there is also an IRA over here. So this is the traditional IRA that's pre-tax. Roth IRA is over there. And then you also have your 403B, your 457. So these are all the different retirement accounts. All those are IRS identifiers. So if you work for, what type of industry are you in? For those of you that were a federal service or a federal job, TSP for savings plan. Now, all of these have a Roth component now. And all that means is whatever you decide to put in there, it's tax-free. You don't get the tax deduction. So it's like, well, do I want the tax deduction or not, right? And then the Secure Act 2.0 just passed, this past January. Basically what that means is before, let's say I contributed $10,000 in my Roth 401k, my company matches 6% of that. It used to be that whatever I put into my Roth 401k, I get tax-free, but my company will put it in a 401k traditional and takes the tax write-off. Well, now I can convert that into a Roth 401k. So the company match can now go into the tax-free side, which is kind of cool. There's a lot of changes going on. And if I have a 401k, 457, 403b, TSP, all that, you can also borrow against that for a down payment on a house. Pretty cool. If you have a Roth IRA, you can access $10,000 with no penalty for a first-time home purchase. Also very cool. Educational expenses, family medical hardship, $10,000, you can access that. Let's see, what else am I missing? That's pretty much it. So try to make it as simple as possible on a very complex situation. But do any of you have any questions about that? No questions? No? Everyone's got their number figured out, ready to go? All right, was this informative? Was good? Okay. If you want to know more, there's a sheet at the end. You can jot down your information, answer the questions, and say, hey, you know what? I want you to look at all my stuff, and I want to sit down with you and go over my macro asset perspective, which is basically what this is, and we can talk. All my contact information is there. You have my email, my cell, and my direct office line. I am here for you. I do not charge a consultation fee. That's it.